Hello, I am Devashish Chakravarty. Let us look at stock exchanges today. What is a stock exchange? A stock exchange is a platform where traders and investors can trade on securities and stocks. What would be the list of securities that they can trade on? That could be shares, could be derivatives, could be bonds, and could also be various other financial instruments that have been specifically created. The stock exchange is also a platform which can be used by companies to distribute dividend or to pass on interest. Stock exchanges first came into being in as early as the 12th century, when traders would get together to figure out ways of reducing their risks, to trade in various businesses, etc. Over a period of time, these got formalized into various bourses, and thereafter, when commodity trade picked up in the 18th and the 19th century, people started trading in futures. Right now, the advantages of having a stock exchange include, firstly, companies are able to go public and thus raise funds. Secondly, companies can fuel their growth by issuing shares on an exchange. Thirdly, small investors get a chance to own parts of big companies that earlier only large investors had access to. Fourthly, companies can choose to raise debt through issuance of securities. Fifthly, the government can choose to raise funds through stock exchanges. How will the government raise funds? The government's primary source of funds is taxes. So instead of taxing people, the government can issue bonds, which are in the form of debt. The bonds have an interest rate called a coupon. By issuing a bond, the government is able to mop up money for its operations. Of course, at the time of paying of the coupon or at the time of redemption of the bond, the government might still need to tax its citizens to pay off these bonds. These are the various advantages that a stock exchange provides. What is the role of a stock exchange? Its role is to ensure that there is an equitable platform for all kinds of traders and investors. It thus monitors all the trades that take place. It provides a repository of transactions, a record of transactions, and it also ensures that all compliances are adhered to by all the players. To trade on a stock exchange, you need to be thus a certified member who can be monitored by the stock exchange. In the modern times, electronic trading has made things much faster. It has also made record keeping much easier. Earlier, in the olden days, when shares used to be in the paper format, the movement used to be much slower. Right now, in the electronic format, even the record keeping is instantaneous. Stock exchanges can be differentiated by various roles they play. There might be separate stock exchanges for commodities, separate for metals, or there could be a common stock exchange for all the various kinds of financial products there might be. In India, we have the Bombay Stock Exchange, also known as the BSE, as well as the National Stock Exchange, known as the NSE. Apart from that, there is a commodities exchange too. Remember that it is not necessary or compulsory for a company to be listed on the stock exchange. A company can remain private if it so desires. Common thinking goes that a publicly listed company has better corporate governance or management. This is not necessarily true. As we have seen in the case of Enron or even Satyam, publicly listed companies have gone bad too. It is not necessary that once a company is listed, all the trades have to be done on the stock exchange, that the shares have to be purchased and sold only on the stock exchange. Even that is not necessary. Even private transactions can happen. These are known as OTC or over-the-counter transactions.